Welcome to this IANA webinar, Inside the Numbers, 2018 Year in Review and 2019 Outlook. I'm Hal Pollard, the Director of Education at IANA, and I'm pleased to introduce our panel today from TTX Company. Pat Casey, the Vice President of Fleet, Peter Wolf and John Woodcock, both Directors of Market Development. Today, our guests are going to talk about the economic conditions that we're looking at, 2018 IANA numbers, the year in review, the international intermodal discussion, and we'll wrap up with a domestic intermodal discussion. So let's get started. Over to you, Pat.
Very good. We're going to give you a brief economic overview to prepare for talking about intermodal details. So we'll start with that first slide about the GDP. And you can see that it was very strong in the middle of 2018, stronger than it had been since 2015. So very good. Expected to slow down a little bit in the fourth quarter, which was not reported yet because of the shutdown. Now that should be done in a couple of weeks, but hasn't been done yet. It is expected to be a little bit slower in 2019 as well, especially in the second half. And we'll see where that goes too. Lots of uncertainty about economic policy right now that's driving things. Also on the Q4 estimate for 2018, it shows that inventories went down in Q4. So that was a forecast. Curious if that happened because of the surge in imports from China, which we'll talk about in a little bit from now. Let's go to the next slide. So this is the ISM index that tracks industrial output. And it has been trending down over the last few months, really since mid-2018, and we'll see where that goes. Industrial production in January actually dropped 0.6% compared to December, so it was down quite a bit. And for trade, it's particularly important that we look at those new export orders, which are the lowest of anything on those indexes. So on to the next page. The petroleum prices have been tumbling, but diesel prices have gone down just a little bit, and that is a very, very important thing for the intermodal industry, the intermodal share, especially for shorter haul loads that can switch back and forth between intermodal and truck, depending in part on fuel prices, as well as some other things. So we'll see where that goes. That's very tough to forecast. Now, even for our company, we don't call it a fuel forecast. We call it a fuel assumption because who knows where it will go. So the next slide shows consumer confidence dipped down quite a bit in January, and many, many people think that was because of that government shutdown, and that could have been the reason. So we'll see, since that shutdown seems to have gone away, will that pop back up in February? That's important too for spending that we see is also a driver of intermodal volume. And then the next slide is a summary of those major economic factors that we forecast for 2019. Many of them a little bit slower than in 2018. Not a lot slower, a little bit slower. Some better. Investment, housing, and vehicle production we think will go up a little bit, though housing recently has been very flat, and we'll see where that one goes. But we do think that GDP, consumer spending, retail, sales, investment all be a little bit slower, as well as industrial production. Mexico GDP growth, and that's part of North American intermodal, as is Canada. So Mexican GDP growth is expected to go down because it almost always does after an election in Mexico. And Canada is expected to improve just a bit. So those are the brief comments on the economy, and look forward to any questions later on that.
Okay, so John and I are going to go through a few slides just summarizing the numbers. And for 2018, it was a pretty good year for just about all intermodal segments. Trailers had a particularly good two-year run. They increased 6.4% in 2017, and then another 10.6% as shown on the screen last year. By country, the U.S. had a strong year, growing 6.1%, which followed 3.5% growth in 2017. In comparison, Canada grew about 3.5% in 2018, but that followed 11.9% intermodal growth in 2017. So over time, the growth numbers seem to bounce back a little bit. And then the Mexican volumes, as Pat was talking about, they're the slowest growing about 3.1% in 2018, and that followed only a 1.4% increase in 2017. And then slide 14 is pretty much the same thing as the prior slide, except that it shows the volume estimates in addition to the growth rate. And trailers, again, show that really robust growth, but on a volume basis, Trailers are the smallest segment by far. And then looking at the regional loads, the slowest growing region was Eastern Canada. But again, that was coming off an 11% growth in 2017. And the Mountain Central was the fastest growing region, and that was on top of 2017's 11% growth. But the Mountain Central is also the smallest region by volume. The total, which isn't on the slide, but the total for 2018 regional loadings, of course, ties into the prior page, and that's 5.6% growth. And for those keeping score, the 2017 total was 4.7. So the last 2 years of pretty good intermodal growth.
So just a few more comments on this slide, further to what Peter was mentioning with regard to Eastern Canada's difficult comps. As many of you may know, CP eliminated their expressway trailer service between Montreal and Toronto in June of 2018. So that certainly had an impact on the year-end results. And then with regard to Mexico originations, as Peter mentioned, they also underperformed relative to the North American network. This was likely due to subdued economic activity coupled with the strong activity north of the border. Mexico's cross-border intermodal traffic is quite imbalanced, and it can require lengthy movements of empties into the market from the U.S. Given the strength within the U.S. market on the domestic container side, box owners reposition fewer empties into the country, into Mexico, resulting with fewer loads northbound.
So the next slide, the top growth lanes, and just sort of illustrates some of the things that you can do with the IANA database and slice and dicing it to see what regions are growing between what regions. This can also be cut by container size, so you could see domestic volumes. You could look at international volumes. So in 2017, 5 of the 6 top growth lanes included at least one endpoint was Canada. But in 2018, that shrunk to just one lane. And the fastest growing lanes, the South Central to South Central or the Mountain Central to Southwest, were driven pretty much by domestic container or trailer volume, while in 2017, the Canadian growth was probably driven by international volume. And then the next slide, it's going to be the slowest growing lanes. So now we're showing you the dogs for the year. And I guess the good news about the dogs is they really didn't repeat from the prior year, with the exception of the Midwest Mexico lane, and that had one of the worst declines of any lane, down 11.8% in 2018. And unfortunately, that was followed an 8% decline in 2017 for the reasons that John was talking about a moment ago. Yeah. But all the other lanes are new to the list.
Yeah, and you may ask, how do the empties affect the movements here, or the volume shown? Private box movements are typically counted as revenue moved by the railroad. So they'll show up in the statistics either as loads or empties. So that is what is certainly affecting the Midwest to Mexico lane.
So we went through the data rather quickly, and now we'll spend a little bit more time trying to explain some of the numbers. And so I'll talk about international intermodal, and John's going to chime in whenever I say something stupid. And then John's going to talk about the domestic intermodal, and I won't need to chime in at all. Yeah. So international intermodal starts with how much imports came into North America to begin with. That's always the base. And for 2018, imports grew 6.1%, so a very strong pace. And again, that looks especially good when comparing it to 2017's growth rate of 7.7%. But as Pat alluded to, and we'll talk more about in a minute, some of 2018's growth occurred as shippers pulled forward cargo that probably would have come in 2019, but came in to avoid the potential tariffs. And we have a couple more slides on that in a second. So as a result of the 2018 surge, basically December of 18, the forecast for 2019 was reduced a bit. So prior to December, we might have thought 2019 import growth for North America would have been in the 3% range or so, maybe 3.1. And we revised that very recently to bring it down to about 2%. And what's interesting, I think, about the 2% is that typically imports grow at a multiple of GDP or higher than GDP. But as Pat's slide 11 in his section talked about, that our forecast for GDP in the U.S. for 2019 is 2.7%. For Canada, it's 2.2%. And both those GDP growth rates are higher than import growth rate. And that would be the first time that I can remember where imports were growing at lower than GDP. And so let's talk about the surge for a minute. During our last webinar in August, you may recall we discussed whether potential tariffs would drive increased volume. And the question was asked at that time, did we see any evidence of it in the data? And back in August, we really didn't. It really was more of a late third quarter, fourth quarter, particularly a December surge. And as you can see on the screen, imports were up 27% in December from China. So through November of 2018, U.S. imports grew at a 5.2% pace. But with that surge from China in December, the year finished at a 6.5% pace. That's quite a jump for just 1 month. And so, as we talked about, we think that the 2019 imports are going to be down as a result of all that. And I think the chart on the bottom, the blue chart, shows that early in 2018, with the Chinese New Year and the up and down, I think it's February of 18 had pretty robust growth, but that was up a very weak comp. But you can see that December of 18 is really when all the imports really came in. And then you can look at the third quarter too, or the late third quarter, fourth quarter, with growth in November and October. But even so, that really wasn't implying a surge. There was pretty decent consumer spending, and so retailers are bringing in stock to restock what was selling. So we really only saw evidence of the surge in December. So one more slide on the surge. The chart on the right shows import growth from China in the fourth quarter. And what we've done is that the blue bar represents the TTX's forecast for the commodity absent the tariffs, while the yellow bar shows the higher amounts that actually came in during the quarter. And you can see that some commodities don't have any yellow. As an example, footwear. That was 5% growth in the fourth quarter, and that's all blue bar. Why is that? So there's already substantial tariffs on footwear. A fair number of shoes have tariffs that exceed 50%, a lot of tariffs at 65%. So the threat of a 25% tariff on something that already has a 65% tariff is meaningless. Can't go any higher, you're already at 65%. So that's why the solid blue bars really didn't change. But the yellow bars say hardware, lighting, or household machinery, which is on the chart on the far right, the bar on the far right. We think that a fair amount of imports came in the fourth quarter because people were very concerned about tariffs being applied to these commodities that really don't have much tariffs applied to them now. And I think what's interesting for the transportation community is while a lot of goods came in December, not that much moved inland, or at least in 2018. And that's what the chart on the bottom left says, that the share of product moving inland hit an all-time low in December of 18, which implies that a lot of cargo is going to move in January, February, and March. And we don't have all the data yet. The IANA data for international intermodal for January is showing 5.1% volume growth, January of 19 over January of 18, for the U.S. West. We don't have the import data, but looking at a couple of port websites, it looks like imports may be growing at most 1.5%. But we don't have all precincts reporting, so it could be a little bit different than that. But that would suggest that the IPI volume is growing much faster than the import volume, which makes perfect sense, right? It's saying that the volume that came in really late in 18 is now moving in early 19. And so shifting gears away from talking about the surge, just talking about a couple of things, logistics practices that we've always watched and we've talked about on each of our webinars. The first one is all water share. TTX defines all water share as the percent of imports that originate in East Asia and that route via either the Panama or Suez Canal to the East Coast. Back in 2000, that share was just a scotch below 15%, and now it's over double that amount. In 2018, saw continuing all water share gains, which most likely results from the combination of faster population growth in the southeast as well as the south. So freight is sent to that part of the country as opposed to sending freight to the West Coast and then ship it to the Midwest. It's not that population is shrinking in the Midwest, but population is growing faster in places where there's all-water service offers a pretty decent option. The other thing is we're seeing continuing shifts in production from China to Vietnam and Southeast Asia. And depending on the origin, the routing of that freight via the Suez Canal to the East Coast is in many cases faster and more convenient than West Coast discharge. So that's driving some of these numbers too. And then again, the other trend that we watch is transloading. And for those new to the call, transloading is logistics practice of switching cargo or transferring cargo from the marine boxes into 53-foot containers or trailers for inland shipment. For 2018, TTX estimated that 33% of imports transloaded and shipped inland by rail from the port of LA and Long Beach combined. Now, transloading occurs in most ports, but it's really most prevalent on the U.S. West Coast. And the graph in the left shows transloads as a share of imports, while the graph on the right shows volume. And this can get a little confusing at times, but even if the share remains flat, overall transload volume can increase as long as overall imports are increasing. And for the first quarter, maybe the first half of the year, I think the graph on the left might be a little bit wonky because we're comparing transload volume to total imports, and those might be down a little bit because so much came in December. But overall transload volume really shouldn't change. That goods that were intended to come in, say March or April, maybe it's a seasonal barbecue or lawn furniture, that we're then going to get transloaded and sent to areas that were having the greatest sales. So if the example I like to use that if Nashville is having a nice spring and the Midwest is having a miserable spring, retailers might send more goods to that location and less goods to Chicago until the weather warms up. And if those goods came in, say, in December, because the chart that we were showing a few slides back showed that household goods had a big spike in December, the retailers aren't going to ship those to the store shelves until April anyway. So the transload volume should stay pretty much where we think it is, a little bit of growth year over year, but share is going to look wonky for the next 6 months or so. And I think we have one more slide in international intermodal, and then I'll turn that over to John. So international intermodal is sometimes referred to as IPI, and just to touch the bases on the definition, this is when an international marine container, a 20, a 40, or a 45-foot container, owned or controlled by the ocean carrier, routes inland by rail. And with the notable exception of 2016, the IPI trend tends to follow import volume growth. And while the headline of the slide says that IPI slowed in 2018, the fact is that import growth slowed a little bit, right? So we talked in the very first slide in this section, imports grew 7.7 in 2017 and 6.1 in 2018. So our forecast for IPI, 5.4%, is a little bit less than 2017, but again, it follows the general import trend. And then we'll see what happens with the up and down in 2019, and we're showing 2.7%. That should still be fairly accurate because the goods landed in December, as you've heard me say a bunch of times already, and you're sick of it, but they're going to ship inland in the first quarter of this year from an IPI standpoint. So it really shouldn't affect the forecast all that much.
So it's really an issue of timing, month to month, as opposed to year to year.
It's almost as if you could say 2018 for international logistics was really the months of January through November, and 2019 is really the month of December of 18 through December of 2019, if you could split the year that way.
Great. Okay. Thanks, Peter. Going on to domestic. So first of all, I will touch on a few of the leading market indicators that we enjoy in the freight transportation and trucking markets. First is the Cass Freight Index that many of you probably know. It really demonstrates a pretty dramatic and strong year for freight activity in 2018. We applied some weighting to their numbers to understand what the annual performance was, and it indicates that shipment growth based on the Cass Index was about 7.9%. This is reported by their large shipper client base. As you can see, demand waned somewhat in the last 2 months of the year, but it did remain comparatively strong. As you can see in prior years, particularly 13, 14, and 15, and 16, December is traditionally a pretty slow month. And while we did have a taper as the quarter progressed, it did flatten out somewhat. So really did finish out the year in a pretty strong position. Going to the next slide is the FTR index. So this is a truck loadings index that we receive on a monthly basis. And it provides a bit of a different demand curve than you'll see in the Cass Freight Index, but it also does illustrate that 2018 was certainly a remarkable year. We tried to weight this on a monthly basis and came up just north of a 4% growth rate in truck loadings based on the FTR index. Going to the next slide, the final reference slide on that we use to look at freight demand, the Morgan Stanley's Truckload Freight Index illustrates changes in the truckload supply relative to truckload demand. And so as you see increases on the scale, that indicates more favorable carrier conditions, really tighter conditions of supply relative to demand. And as you can see on this slide, that the increasing tightness in Q4 of 2017, which is the purple line, as you can see it starting to edge up in the last quarter of the year. This upward curve lasted well into 2018. In fact, I believe they actually had to change some of the scaling on this earlier in the year. Carriers have since adjusted to the new world of ELDs and the new regulatory environment with hours of service, and more equipment has come online. And we think that economically derived demand appears to have somewhat moderated through the year, and this has provided a more balanced condition as we enter into the first quarter of 2019. Class 8 truck orders. So driver pay reportedly has risen by the mid-teens, or rose by the mid-teens on a percentage basis in 2018. We're hearing typically driver pay went up about 15%. That likely enticed drivers to either stay in the industry or return from other fields of endeavor. The trucking industry further reacted to the profitable conditions by ordering more Class 8 tractors. It must be considered that as significant as you can see the orders were in 2018, they were record-breaking in every respect. But it has to be considered that this wasn't straight capacity growth. So many carriers cycle their tractors as frequently as every 2 to 3 years. And 2018 marked a significant replacement cycle. And you can see the last replacement cycle was back in 2014 into 2015. So in addition to it being a replacement cycle, obviously, this was also spurred by greater carrier profitability. When they're making a lot of money, they need to spend it. There were some the tax law changes in the tax reform package in late 2017 created a more attractive avenue for investments with the depreciation schedules. So that certainly spurred some carriers on. Also, the operating benefits of new tractors is certainly helping the issue, largely with greater fuel economy, the latest tractor trailers. So a lot of carriers are trading in and trading up to get a warranty as well as much better fuel mileage. Finally, the new equipment is also an effective recruiting tool to entice drivers. So that's also been a sale of if you're trying to recruit a driver and you have a 3-year-old tractor, there's a big opportunity for you to lose that driver because they are going to go to the carrier with the nicer cab. Tractor lead time now, the orders have been so strong, lead time is upwards of 11, 12, 13 months in many cases, which pushes delivery time into 2020. Typically, the truckload carriers don't have a great sense of confidence with predicting demand that far into the future. And so they've started cutting back on their order schedules. And as you can see, it started dropping significantly in November and in December. January was also reported as being a very tame month. So the carriers have started to tap the brakes on providing additional orders to the OEMs. The domestic container fleet, it's an interesting story here. It expanded at an impressive rate in 2018, which is 7.8%. So this, as we see it, was a bit of a supply catch-up as the fleet demand outpaced growth in the first half of 2017. 2017 growth was only about 2.7%. And so there's a lot of catch-up to do. And interestingly, the initial outlook for 2019 is nearly as robust, with an estimated growth rate of 6.9%. We'd like to interpret that as being a real positive bet on 2019, but likely some of that growth is going to be attributable to slightly lower container productivity, given a shift, maybe not a large-scale shift, but somewhat of a shift from live loading scenarios to drop and hook agreements at shippers, as has been reported to us by many intermodal participants. It's also expected that the reefer container fleet will be growing at a higher rate than the population as a whole. That's part of a general movement away from trailers into the containerized double stack configuration. So overall, domestic container volume finished 2018 at 4.9% overall growth. And our initial expectation is that economically derived demand will remain solid through 2019. And with carrier service improvements combined with greater box capacity, it will buoy growth. So it's a pretty big nut to get 2 years of about 5% growth, but certainly attainable in this market environment. So going on to trailers surprised on the upside for the second year running. As Peter was mentioning earlier, trailers grew in 2017, primarily in the second half of the year, but for an annual rate of 6.4%, and then grew last year at 10.6%. In our internal analysis, we split the trailer segment into three different market segments. The first being parcel and LTL, the second being temperature controlled, and the third dry van truckload. Those segments are divided in volume-wise, roughly 50% parcel and LTL, and 25% each in volume for the temperature controlled and dry van. Based on our discussions with industry participants, growth was fairly uniform across all segments, and continued performance will be challenged by year-over-year comps, especially given that the first half of 2019 will have to compare against the 2018 that included CP's aforementioned expressway service, which was a trailer service between Montreal and Toronto. Also, any conversions in the temperature control segment from trailer to container will knock the trailer numbers while being net neutral overall in the domestic side. Finally, one short slide to show you the IANA numbers provide a segmentation based on trailer length. And this certainly aids in understanding the trailer segment performance, as the non-53-foot segments are almost exclusively the domain of LTL and parcel carriers, even though some 48 reefers are still in service. And of course, the LTL and parcel folks also use 53-foot trailers to a certain extent. So that's what I have for the domestic side.
So what we're watching. So Pat's probably better explain this than I can, but I'll take a shot at it. So one, just overall, what we're watching are the same three things that we talked about in the August webinar. And it isn't because we're lazy and can't think of anything new to talk about. It's still on the radar screen. And this is one reason why Pat said at the beginning of his presentation, there's a lot of uncertainty. There's been uncertainty for a long time, and it's continuing. And that may be beginning to show up in the economy. So the yield curve, if you look at the blue line, is the typical yield curve that you would see with bonds, where the shorter term bonds have a lower interest rate than the longer term bonds. But the yellow bar represents the yield curve that we just took a sampling of to prepare the presentation. And you can see that while the 20-year bond is a little bit higher than the 1-month bond, it's beginning to look really flat over a long period of time. And that's really due to all the uncertainty that's in the environment right now.
Right. That's part of the pessimism that's reflected from that. And also in the finance sector, banks borrow money short term and lend it long term. And if that difference is very small, that pulls them back.
The next slide is the exact slide we showed back in August. And what it represents is the price elasticity of containerized imports. But that really isn't the message of the slide. The slide is, we don't know what's going to happen with tariffs. We've been talking about it for a long time. And tariffs, all they are is essentially a price increase on imported goods. And so if a tariff goes into effect on March 1st, that's going to affect 25% on almost all of the goods imported from China, $500 billion worth of goods, which is what's been discussed so far. That could be a pretty big price increase. So we'll have to see what happens with all of that. But the way to read the slide is simply we've tried to measure price increases versus quantity demanded. It's the old elasticity equation that maybe you remember from your economics classes. And in total, if prices increase 1%, imports fall 0.86%. That's what the yellow bar in the center means. And so if you had a 25% tariff, that doesn't mean it's a 25% price increase. It could be that the sellers are going to absorb the prices. It could be that the Chinese government could change their tax policy and lower taxes, so sellers could essentially lower their prices and still come out whole. So we'll have to see what happens with prices. But again, the bigger issue is really what's going to happen with tariffs in general. The last slide that John and I will talk about, and we alluded to it in one of the prior slides in the international section, is what will happen with the implementation of IMO 2020. And as we talked about, like I say, in August, IMO 2020 is the requirement to either burn ultra-low sulfur fuel or place scrubbers to control emissions on vessels operated by the major ocean carriers. And if you're going to burn the ultra-low sulfur fuel versus bunker, which is what's consumed today, that may be a $200 to $300 premium for the more expensive fuel per metric ton. Ocean operations by the vessel operators, roughly 50% of the cost to operate the ship is attributed to fuel. So a $200 to $300 increase in cost per ton of fuel could maybe be a 22 to 25% increase in overall costs. Now, how that translates into rates remains to be seen. Other options that the ocean carriers have is install the scrubbers, but one, not that many vessels have scrubbers installed, so to get them installed by the January 31st deadline is problematic. And two, even if you have a scrubber, you have to figure out what to do with the residue that it collects, and that, I think, limits some of the practicality of the scrubbers. Another option would be to use LNG, which is a very clean fuel, can help the ocean carriers meet the emissions control requirements, but that doesn't offer any cost savings, at least yet, over burning marine-grade diesel or ultra-low sulfur fuel. It goes by various names.
So the new fuel that they'll be using, the low sulfur fuel, has various names: marine gas oil, marine diesel oil. It's a distillate, and as such, it really competes in the same refining area as diesel fuel. And so based on our analysis and discussions we've had in the market, there's going to be a direct impact on related diesel fuel demand. And so that we think is going to put upward pressure on diesel fuel prices. What that is, as Pat was alluding to earlier, talking about fuel prices and oil prices in general, it's almost impossible to predict what the impact is going to be on a monetary basis. Some pundits have been speculating that it would increase diesel prices, at least temporarily, upwards of 20%. That would start in the fourth quarter of this year. What the actual impact is going to be and what the term of the impact is going to be is to be determined. So we're watching this closely because obviously upward pressure on diesel would affect intermodal demand and also would affect import volumes possibly.
Right. I think that, trying to put it a little perspective, when the Panama Canal expanded and you could operate large vessels, 14,000 TEU vessels versus the 4,500, 5,000 TEU vessels, the cost savings per 40-foot container was estimated to be, by TTX and others, around between $200 and $250 per 40-foot container. If you look at MARPOL and you say if you have to burn $200, $300 more expensive premium fuel, that might lead to that same $200, $250 per box savings if you just take it to the West Coast versus the East Coast. And when I say savings, the fuel costs are going to go up whether you operate a vessel to the East Coast via the Suez Canal or Panama Canal, or if you operate Trans-Pacific services. But they're going to go up at a greater rate to the East Coast than they will to the West Coast, because you burn about twice as much fuel taking cargo from Asia to the U.S. East Coast than you do to the U.S. West Coast. So does that incremental cost increase of $200 to $250 cause freight to leave the U.S. East Coast and bring it back to the West Coast? And as I said, that the $200 to $250 is the same cost savings that the ocean carriers enjoyed when the Panama Canal expanded. And all-water share in 2016 to 2018 climbed about 3 percentage points, which was about a 10% increase in volume. Would that same amount of volume revert to the West Coast? That's just pure speculation on my part. There are a bunch of other factors that we were talking about earlier, that there's population shifts, could be congestion on various ports. So it isn't simply just the operating cost driving where the freight is going to go. But there could be a pretty significant shift back to the West Coast. We'll have to see.
Also, logistic strategies of the big box retailers and such.
Right. So I think that sort of wraps up our prepared comments. And if there are any questions people have, we're always happy to answer them as best we can.
Terrific. Thanks, gentlemen.
Well, that's all the time we have for today. I'd like to thank our guests from TTX for joining us and sharing their insights on this edition of Inside the Numbers. If you would like more information about IANA's ETSO database, the source of much of the data discussed here today, please visit us at intermodal.org or send us an email at info@intermodal.org. Thanks for joining us at IANA, the connecting force behind freight.